Hello everyone. Welcome to the Stock Minds web channel. AppLovin, Nasdaq app, has surged into the spotlight this quarter, delivering exceptionally robust Q1 2025 earnings that blend high growth with compelling value. With revenue up 40%, EPS nearly 2.5 times last year, and solid cash flow, it's hard to ignore the momentum behind this ad tech powerhouse. As investors weigh the outlook, App stands out as a standout growth stock with strong fundamentals. In this video, we will dive into AppLovin recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About AppLovin. Founded in 2012 by Adam Foroughi, Andrew Karam, and John Kristanak, AppLovin is a Palo Alto-based mobile technology company. Its platform delivers AI-driven advertising and analytics services to global app developers, spanning the entire lifecycle, from user acquisition and monetization to analytics and scaling. AppLovin's portfolio includes Max, Mediation, App Discovery, and Spark Labs. It also built and later divested Lion Studios and other mobile gaming initiatives as part of its strategic shift from gaming to high-margin advertising. AppLovin financial performance. AppLovin delivered an outstanding financial performance in Q1 2025, showcasing rapid growth across key metrics. The company reported revenue of $1.48 billion for the quarter, a significant 40.25% increase compared to $1.06 billion in Q1 2024. Earnings per share (EPS) surged 148.1% year-over-year, rising from 67 cents to $1.67. On a trailing 12-month TTM basis, revenue reached $5.13 billion, up 41.63% from $3.62 billion a year earlier, while EPS jumped an impressive 232.19% from $1.67 to $5.53. Free cash flow per share also saw strong growth, more than doubling from $3.26 to $7.30, an increase of 123.93%. The company's profitability remains robust, with a gross profit margin of 77.72%, a net profit margin of 37.39%, and a free cash flow margin of 49.33%. Additionally, AppLovin boasts a return on assets of 27.27% and an exceptional return on equity of 287.51%, reflecting its efficient capital usage. However, the debt-to-equity ratio stands at 6.45, indicating significant leverage. Over the past 5 years, AppLovin revenue has been growing at 34.6% CAGR, net income growing rapidly since 2023, and free cash flow growing at 77.8%. AppLovin Fiscal 2025 Financial Forecast. Looking ahead, analysts forecast AppLovin's 2025 revenue to grow by 21.18% to $5.71 billion, with EPS projected to rise 79% to $8.11. The average analyst price target is $461.68, with buy rating, implying a potential upside of 42.19%, while the most bullish forecast sees the stock reaching as high as $650, an upside of 100.15%. App stock price performance and valuation. At the time this video was created, App stock was trading at $324.70 per share. AppLovin stock has delivered extraordinary returns over the past year, representing a 320.7% increase year-over-year, dramatically outperforming the S&P 500's gain of just 8.6% in the same period. Since IPO in April 2021, the stock has appreciated by 432.3%, again outpacing the broader market, which rose 42.42%. Despite this massive rally, AppLovin's valuation remains justifiable given its strong earnings growth and profitability. The stock trades at a trailing 12-month price-to-sales (PS) ratio of 21.37 and a forward PS of 19.25, while its price-to-earnings (PE) ratio is 58.7, with a forward PE of 40.04. Its price to free cash flow (PFCF) ratio stands at 43.37. Based on Fiscal.ai data, if we look at the valuation since 2023, AppLovin's forward PS, forward PE, and PFCF are above the average, but they are lower than earlier this year. While these multiples may appear elevated at first glance, they are supported by the company's rapid earnings expansion, robust free cash flow generation, and high margins. AppLovin growth potential. AppLovin growth potential remains robust, driven by several factors. 1. Expansion into e-commerce advertising. AppLovin's expansion into e-commerce advertising marks a significant growth opportunity beyond its traditional mobile gaming focus. In Q4 2024, the company successfully captured substantial holiday shopping ad spend for the first time, validating the effectiveness of its AI-driven advertising models across diverse verticals. Bank of America analysts estimate this e-commerce push could increase AppLovin's total addressable market by $50 billion. Advertisers participating in pilot programs reported strong returns, with incremental sales rising between 25% and 35%, demonstrating impressive ROI. This expansion leverages AppLovin's AI platform to target new audiences, including direct-to-consumer brands, and positions the company to tap into the rapidly growing retail advertising sector. Early successes indicate that AppLovin's technology can drive meaningful sales growth, supporting its broader strategic shift toward becoming a leading player in digital commerce advertising. 2. Connected TV, CTV market entry. AppLovin's entry into the connected TV CTV market is significantly strengthened by its 2023 acquisition of Whirl, a leading streaming TV software platform. This move positions AppLovin to capture growth in the rapidly expanding US CTV advertising market, which is projected to reach $34.3 billion by 2025, growing at an annual rate of 15%. Whirl's infrastructure enables AppLovin to deliver targeted, measurable ad campaigns across more than 300 million connected TVs globally, integrating seamlessly with its AI-driven Axon platform. AppLovin's cross-channel advertising capabilities allow campaigns to bridge mobile and living room screens, enhancing effectiveness. Studies show that such cross-channel campaigns can boost mobile conversion rates by up to 30%, highlighting the strategic advantage of combining mobile and CTV advertising to maximize advertiser ROI and audience reach. This expansion diversifies AppLovin's revenue streams and strengthens its position in omni-channel advertising. 3. Total addressable market expansion. According to Rockflow, the global digital advertising market is expected to grow significantly, increasing from $136.07 billion in 2024 to $175.66 billion by 2028. This growth reflects a compound annual growth rate, CAGR, of 6.5%, driven by continued demand for digital marketing across various industries. AppLovin is strategically expanding its focus beyond the mobile gaming advertising market, which itself is projected to reach $13.7 billion by 2028. By moving into the broader digital advertising space, AppLovin is tapping into a much larger opportunity, approximately 13 times greater than its original market. This expansion allows the company to leverage its AI-powered advertising platform across multiple verticals such as e-commerce and connected TV, positioning it to capture significant market share and drive long-term growth in the rapidly evolving digital advertising ecosystem. Risks to consider. Although AppLovin presents a compelling investment case, we should be mindful of potential risks. 1. High level of debt. AppLovin has a high level of debt, with a debt-to-equity ratio of 6.45 and net debt around $3.71 billion as of early 2025, which poses a risk if the company cannot service its debt or if earnings decline or interest rates rise. Its debt-to-EBITDA ratio of 1.32 indicates earnings may not fully cover interest expenses, increasing financial vulnerability. 2. High competition. AppLovin operates in the highly competitive mobile advertising market, facing significant pressure from tech giants like Google and Meta, which dominate the $667 billion digital advertising industry. Failure to sustain its competitive edge, particularly with its AI-driven Axon platform, could lead to a loss of market share, reduced revenue, and diminished growth prospects, especially as competitors continue to innovate and capture larger portions of the digital ad spend. 3. Regulatory and compliance risks. AppLovin enforces strict policies on content and advertising, with prohibitions on fraudulent traffic, malicious code, and restricted content categories such as gambling, political ads, and health products. Non-compliance can lead to suspension or termination of accounts and services. Privacy risks exist due to the complexity of managing privacy configurations across multiple SDKs wrapped by AppLovin. In some cases, compliance with regulations like GDPR may not propagate correctly to all integrated SDKs, potentially leading to privacy violations. Conclusion: AppLovin stands out as a high-growth technology stock with strong financial performance, solid fundamentals, and impressive stock price momentum. The company's Q1 2025 results highlight significant year-over-year growth in revenue, EPS, and free cash flow, supported by exceptional profit margins and returns on capital. While risks such as leverage and market volatility exist, the company's strong execution and future potential make it a compelling investment opportunity. For growth-oriented investors seeking exposure to the digital advertising and AI-driven technology space, AppLovin offers a powerful combination of momentum, profitability, and upside potential. But remember, this is not a financial advice. What do you think about AppLovin? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching, and see you in the next one.